Hello, very good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Very good morning. Today will be Thursday, the 10th of July 2025. So, as usual, before we jump straight into the of today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap what has taken shape yesterday, as well as in today's early Asia session before the start of our daily dose at the usual timing at 11 a.m. Singapore time in terms of key economic data, news flow, and their impact on the respective broad-based cross-asset classes. All right, so now, let us kickstart with the performance of the major US stock indices yesterday. So I would say that the performance of the major US stock indices on a intraday basis, and if you look at the absolute number, is rather very, very rosy over here. So what you could see is that all the four major US stock indices managed to open very strongly. Then thereafter, there was an intraday sell-off until lasting only for about half an hour, where at the not really half an hour, sorry, lasting for about an hour plus. So right exactly at the 11:30 p.m. mark Singapore time, we start to see recovery, and the major US stock indices, all of them closed near the session high. So the SPX managed to gain by 0.6%, the Nasdaq outperformed slightly by 0.7%. The Dow Jones underperformed but managed to ink out a modest gain of 0.5%, and the top performer is the small cap Russell 2000, managed to rally by 1.1%. And what's interesting over here is that the initial push up on the S&P 500 and the S&P 500 and the Dow Jones Industrial Average all hit their respective resistances. Then thereafter, it sees intraday sell-off, and during the start of the before the second half of yesterday's US session, what we could see over here is that means, i.e., at 11:30 p.m. Singapore time, the major US stock index managed to rally, and this rally stopped exactly at the resistance again, which we highlighted yesterday in my intraday technical outlook on the Dow Jones, the S&P. All right, and what's interesting, after hitting this resistance level in today's Asia session, the E-mini S&P futures and the Nasdaq 100 E-mini futures started to show profit taking. All right, down by negative 0.15% each, right, on the E-mini futures and the Nasdaq futures. So if you look at, okay, this is the E-mini futures. Let me share you the chart so that you guys could have a look. Okay, it's not showing. All right, so they're actually doing intraday sell off today as we are speaking. All right, similar for the Nasdaq E-mini futures as well. And where this intraday sell off, it actually took shape exactly at our resistance level that we highlighted yesterday on the we call it intraday technical outlook segment on our daily dose research. So later I'll touch on again on intraday technical outlook segment when I cover the three major US stock indices, which we do on the daily basis: the Dow Jones Industrial Average, where we call the US Wall Street 30 in our platform, the SPX 500, and the Nasdaq 100. Okay, so let me touch on a bit about the rally that is being seen yesterday in the major US stock indices. So the major US stock indices rally is being driven by the mega cap technology stock, especially the top performer, which is Nvidia, yesterday up by 1.8%. And this rally in the Nvidia managed to have a positive feedback loop on the other mega cap tech-oriented stock like Microsoft, Apple 0.54%. Microsoft is up by 1.4%. Then Google up by Google Alphabet, which is Alphabet / Google, 1.3%. Meta 1.7%. Amazon up by 1.45%. However, Tesla is not being magneted into this positive feedback loop yesterday is due to this individual firm-based situation where due to the rivalry between the US president and the CEO of Tesla, uh, which is Elon Musk, right? So over the last few days, Elon Musk wanted to actually form his own political party, and that potentially have a bit of what I call political risk premium being feedback into the Tesla stock. So that's why we explained Tesla is not enjoying yesterday's positive feedback loop is being seen on the rest of the mega cap stocks. And one of the reasons why NVIDIA rallied is there's no firm-based related news flow that causes NVIDIA to rally. So we know that NVIDIA has been the darling of this AI mega bullish run that has been taking shape since 3 to 4 years ago. And the reason why NVIDIA continued to push up because yesterday at the start of the US session, it rallied and it became in history, in US history, and in fact in the global market, stock market history, to hit a 4 trillion market cap. Right, so this is what I mean over here. So NVIDIA hits a 4 trillion market cap yesterday at the start of the US session. So that causes the positive feedback loop to seep into the other mega cap technology stocks. So to actually explain one of the, we call it the backbone of yesterday's US stock market rally. Okay, so we could look at the chart over here. It's hitting the 4 trillion mark. So being the first US public listed company to hit the 4 trillion, and also being the world most valuable company right now in terms of market cap. And it also surpassed Microsoft market cap at 3.73 trillion, and also surpass Apple market cap now at 3.13 trillion over here. All right, so something to take note of as well, that is driving the US market rally yesterday. So what happened in that the US market rally yesterday, it led to the CNN fear and greed index to hit into a extreme greed level. All right, where is it? Yeah, this is the one. Right, so what I could see over here is that this compiled by CNN. So previously it was at this grid over here, and this range. So yesterday's push up by the major US stock indexes led by NVIDIA sees this thermometer hitting the extreme grid level. All right, so the this take this view as over here is that in terms of very short-term movement on the price action, there could be some signs of profit taking upon hitting this extreme greed level, because based on in the past behavior of the how the major US stock indices react when the CNN fear gauge greed fear slash greed barometer and hit the extreme grid region over here, there could be some form of corrective pullback. So later I'll share with you on the short-term intraday technical chart, especially on the short-term hourly momentum indicator. There's also some signs of potential pullback that could take shape. All right. So something to also take note of. So that covers the ground of the US stock market performance. So yesterday, we do see also a news flow relating to tariffs as well. So Trump continues his rhetoric to actually send out more tariff love letters to US trading partners. So yesterday, he sent out 7 letters more on top of the first batch of letters that went out to 14 countries, inclusive of US major trading partners, which is South Korea and Japan. So that's on Monday. So yesterday he unveiled a new round of tariff demand letters. So what's interesting over here is that it includes a 50% rate on Brazil, one of the highest so far announced, right? And what's interesting over here that in Brazil, previously it was not being taxed at such a high rate. Okay, give me a minute over here. Okay, somewhere written around in this text. Okay, let me share with you. Where is it? One second. Yeah, Brazil is the first country to receive one of Trump's tariffs notification that was not on the initial list of trading partners when he announced the so-called higher reciprocal tariffs in April. So in fact, Brazil at that point in time was similar to Singapore. They are only being taxed by the 10% base rate. But this time around, Trump decided to up the ante and tax Brazil 50%. And one of the reasons why he taxed Brazil 50% is because of Brazil is part of this BRCK BRICS group, because he wanted to give a warning shot to the BRICS group of developing nation, which Trump has cast a threat to the US dollar status as a world's key currency. And he also even threatened India. All right. So initially at the point last week, he did mention that a US negotiator and India trade negotiator, they are coming out with pretty soon a deal. But he actually did a bit of twist to India ongoing trade negotiation, stating that he actually where is it? There's this additional 10% tariff on India. Okay, I can't. Okay, it's part of, where is it? Okay, I think it's another news flow. Let me get it out for you guys. Okay, should be here. 1 second. Let me get. Should be this the one. All right. Okay, so Trump said India will have to pay 10% additional tariff if they are in the BRICS over here. So there's a lot of this kind of hawkish, aggressive rhetoric by Trump targeting BRIC nation. So with that, that also could potentially see a bit of we call it a tariffs noise that is potentially could be in the play for the entire of the but the interestingly, the US stock market seems to get tired of this tariff news flow and totally choose to ignore all this tariff news so far. So it seems to us that yesterday's potentially negative impact coming up from this continuation of Trump sending out of this demand tariffs letter to US trading partners doesn't seem to have a significant impact on the movement of the major US stock indices yesterday. And the major US stock indices yesterday chose to actually be more, we call it, impacted by the positive movement seen in Nvidia as it hit that 4 trillion market cap milestone. Right. Yesterday, another news flow and share is more pertaining to the US FOMC minutes. All right. So the FOMC minutes, we showed a discussion among US federal officials in the previous FOMC meeting in June. So that is not much of a big surprise, showing that policymakers are split on how tariffs might impact inflation. So what we could see over here is that there's still a divide among Fed officials over the outlook of the interest rate has been driven largely by different expectation on how tariffs might affect inflation. So policymakers pointed to considerable amount of uncertainty about the timing and size of the duration of the tariffs and its potential impact on inflation over here. So most of the policymakers assess that some reduction in the Fed policy rate will likely to be appropriate this year, but maintain that the overall stable US economy provides them room to be patient on rate adjustment. So what they could see over here, yes, they want to cut rates, but potentially they could still be on the sidelines to wait and see how the current situation in the US economy develop, especially due to the uncertainty of Trump's array of complicating US tariffs policy. So that being said, over here is that market is still now has starts to reduce. So initially, 2 weeks ago, they are looking at 3 potential interest rate cut this year, and right now this has been reduced to 2. And in fact, the July meeting, which is on 30th of July, the next FOMC meeting, close to 94%. I would say it's as a high of 100%. That market participants in the Fed funds futures market is expecting no cut at all. Stampede at 4.25%. Only a very small percentage of 6% expecting a cut by 25 basis point. If you look at the aggregated one down the calendar, taking into account of future expectation on future FOMC meeting dates. So the next cut will potentially come in 17th of September. So previously, as on the 29th of October market, that 2 weeks or 3 weeks ago, before the non-farm payroll data, they're actually expecting a high chance, about 70% chance of another cut to bring it down to 3.75%. But right now, market is now skewing towards no cut on the 29th of October. So after the potential first cut, which is at 78%, to bring it down to 25 basis point lower to 4% to 4.25%, then Stampede on the 29th of October meeting, and a high chance of the second cut to come in the December meeting at 10th of December 2025, which is 85% chance to bring it down lower to 3.75%. So overall, based on the current expectation in the Fed Funds futures market is now in line with what the Fed officials is thinking in the previous June FOMC meeting, where they released their latest dot plot indicating only of 2 potential interest rate cut before 2025 ends. So there is still form of interest rate cut in US, not saying that there's no more interest rate cut in US. So that also lead to dollar strength. We call it a sell off yesterday. So at the start of this week, we see some major US dollar pair showing dollar strength instead of dollar weakness, especially against the dollar yen, against some of the European currency like the sterling dollar and the euro dollar. But after yesterday's FOMC minutes, that shows that almost the status quo is almost unchanged. Still look, Federal Reserve official is still looking for a potential rate cut, but the only view is that they allow them to be more patient, and that causes the dollar strength to thunder out in the US session yesterday. All right, so this is the 5-day rolling performance of the major currency against the dollar. So what you could see over here is that the dollar yen previously was the strongest currency 3 days ago, and the dollar strength starts to tender off in the US session yesterday, followed by the dollar CAD, and the dollar continues to be weak against the euro, the sterling, and against the Aussie, and it's the weakest against the Swiss franc based on the 5-day rolling performance basis. And if you go down to the 1-day rolling performance basis, if you take into account of it right now, so based on the 1-day rolling performance basis over here, we see a bounce off in the dollar Swiss right now. Not much movement on the sterling dollar and the euro dollar, and even in the Aussie dollar as well. So the Aussie dollar, the dollar continues to remains the weakest over here, down by negative 0.18%. There is a bit of catch up on the dollar yen so far. So, all right. So later I'll share with you on the dollar yen chart and some of the intermarket dynamics. Okay, that is ongoing in this dollar yen situation. So more likely this dollar yen is going to trap inside this very complex sideways range since the low of 21st of April. So later I'll touch more about that when I cover the technical outlook segment. All right. So now the movement of this dollar yen so far, let me touch on the second segment right now. So today there'll be a special edition, which is intermarket correlation. So this intermarket correlation analysis only tends to share when there's some interesting development that is taken shape in the global markets. All right. So we know that the dollar yen has been swinging very wildly. As wild swing is more pertaining likely to that ongoing so-called Trump dissatisfaction with the trade negotiation between US and Japanese officials, where the Japan side refusing to accept US rice heading into Japan, and Japan on the other hand wanted US to reduce the automobile tariffs, which is a different sectorial tariff of 25% each, that is universal throughout all country. So this has been managed to hit a kind of a roadblock. So that causes the dollar yen to swing wildly in this last few session over here. And if you look at the fundamental drivers or intermarket correlation of the dollar yen movement, it will be the interest rate, the bond yield differential between the JGB, the Japanese government bond, and the US treasury. So this is what I mean by this. All right. So if you look at since the where is it? Yeah, since April 2024 last year, the bottom of the chart is the dollar yen. So if you stretch it a longer term period, ignoring the intraday noises, since April, okay, let me put it in. Okay, over here. Okay, since late April 2024, these three charts are moving in almost perfect lockstep direct correlation. All right, the bottom of the chart is the dollar yen in purple. All all right, after hitting April 2024 peak, all right, at around this okay, what's this level? Right, somewhere around here, 158, 1460, 160. There's a bit of push up initially. Then thereafter, it started to trade lower, okay, lower high. And this lower high, that means it didn't rally up continuously. It just trade there's a lower high. And this lower high is being driven by lower high that is being seen in the 2-year US Treasury yield minus the 2-year JGB yield. So this is a yield spread between the Treasury yield and the JGB yield on a 2-year tenure, more shorter term. Okay, 2-year is driven by monetary policy, okay, rather than economic factors between the two countries. So view it as the the situation between monetary policy difference between US and Japan. All right. So what you could see over here, that means the US Treasury premium, because the US Treasury 2-year, the difference between the 2-year Treasury and the 2-year JGB year is still trading at a positive level at 3.10%. So we're talking about the yield premium. So the yield premium on the positive side is for the US Treasury is getting lesser and lesser. All right. So that actually also explained that there's this big difference between US monetary policy and Japan monetary policy. So Japan monetary policy is more skewed towards slowly gradual interest rate hike, whereas US monetary policy, as explained by the FOMC meeting yesterday, is still looking for interest rate cuts. All right, so that could potentially see the yield premium between the US Treasury 2-year 3-year Treasury and the 2-year JGB to actually string. Right. So what it means is string. That means, i.e., as an international bond investor, or fixed income investor, I call it, it does not make me to be so attractive to invest in US 2-year Treasury, right? Because the yield premium between US Treasury and JGB yield string, right? I rather go back to the JGB market over here. Similar for the longer term, the 10-year, all right? So the 10-year Treasury yield and the 10-year JGB yield, so that constitute of more of macroeconomic factors like wages, labor market, or whatsoever, and even economic factors like PMI data. All right, so that could potentially impact the movement of the respective country 10-year government bond yield. So the 10-year US Treasury yield, so take it as a 10-year sovereign bond yield. The 10-year sovereign bond yield minus off the 10-year JGB yield also stayed in positive territory at 2.85%, but it has slowly stringed down from 4%, 3.6% previously in the start of this year, and it goes to thunder downwards to 2.85%. So what it means that over here is that the yield premium between the longer tenure US Treasury yield and the 10-year JGB also string as well, the positive premium. That means what it means that US economic, or we call it macroeconomic growth in a way, or growth factor, might slow down versus Japanese growth factors, macroeconomic factors over here. So in terms of, let's say, if I were to be a longer term fixed income investor or a capital allocator, it's more attractive right now to allocate my capital in the 10-year JGB market rather than the 10-year US Treasury because of relatively the positive premium that is being enjoyed by the US Treasury since the start of this year. The 10-year US Treasury bonds since the start of this year over 10-year JGB bonds has starts to be reduced. All right. So if it continues to string downwards, that could actually add further pressure on the dollar yen rate as well. So potentially the dollar yen upside, yes, intraday you may see a bit of noise, but the upside may be kept by fundamental drivers that is not supporting dollar yen strength. So this is what I mean on the intermarket analysis, using the difference between the 2-year Treasury yield versus the 2-year JGB yield and the 10-year Treasury yield versus the 10-year JGB yield, indicating that it's not so attractive right now to allocate long-term capital into the US Treasury market, given if we have a choice to actually look at other markets like the JGB market by capital allocator that invests in fixed income. All right, so that could actually see a bit of pressure to cap further long-term dollar yen strength. All right. ignoring the short-term intraday movement. All right, so this is the second segment on share with the intermarket analysis, which I found that it should actually be addressed given that rather volatile noise that is being seen on the dollar yen movement in the last 3 to 4 days. All right, so now let us now move to the second segment, which is the intraday technical outlook, starting from the FX market. All right, so before that, let me expand my screen. All right, so let's start with the FX market first. All right, so the FX market, let's kickstart with, where is it over here? It should be, yeah, this one. Okay, let's start with the euro dollar. Yesterday, we continues to maintain our bullish bias because price action can't break below the 116.85 short-term pivotal support. So yesterday, during the start of the US session, it was tested again. After this test didn't break, and we start to see potential bullish sentiment start to come in and push up the euro dollar, but so far it can't break our first resistance at 117.70. So without the breakage of this 117.70, we do not want to be so aggressive and tighten our short-term pivotal support level to be so tight above 116.85. So still using 116.85 as my short-term pivotal support, but I do have an intermediate support level to watch as we kickstart today's European session thereafter, kicking to be out around 3 hours time from now. So this will be my support, intermediate support level to watch, which was yesterday's congestion area here. Okay, there's this minor congestion area where it broke out during the start of today's Asia session. So this will be at 117.20. So unless we have an hourly close at the and a bullish breakout above 117.70 during the European session, that I could tighten my short-term pivotal support to 117.20. So for now, I still leave it at 160.85. So this will be my level to watch out for, as price action may retest around it during the start of the European session. All right. So next level to watch after 117.70 will be 118.10, 118.25, which is the minor swing high area of 1st of July. So that's for the euro dollar. RSI continues to be very positive, supporting our bullish bias view for today on the euro dollar, given the fact that it has broken out above this parallel descending trendline resistance in today's Asia session, indicating some form of intraday bullish momentum breakout scenario. However, if price action didn't actually move as expected and starts to tumble downwards with a bearish close and a bearish breakdown with an hourly close at the below the 116.85 short-term pivotal support, then that would invalidate today's intraday bullish bias to kickstart another round of minor corrective decline sequence, exposing the next near-term support in first step at 116.30. A breakdown below 116.30 may see a further extension towards 115.80. That's coming very close to the medium-term ascending channel that is still in place. Medium-term ascending channel support that is still in place since the low of 13th of May 2025. Next up will be the sterling pound. So yesterday, the sterling pound, after initially at the start of this week, we do have a bearish bias, and we now flip back to a bullish bias given that bullish divergence that was being seen yesterday in the hourly RSI. And what's interesting over here is that the hourly RSI also starts to shape that bullish momentum breakout at the start of today's Asia session. So giving us more prudence for our bullish bias stance that we have reverted to yesterday. So with that, no change, still maintain our intraday trend bullish bias with the same levels to watch, given the fact that the hourly price action on the sterling pound or the sterling versus the dollar still can't break above our first resistance, first intermediate resistance zone at 136.70, 136.90 that initially kickstart that last leg of sell-off from 4th of July all the way down to Tuesday intraday low, which is 8th of July. So intermediate support level to watch will be around the 20-day moving average over here. Okay, at this 135.80. So unless we can have a clear bullish breakout and an hourly close above 136.90 during the European session, then I will tighten my short-term pivotal support level to this 135.80 level. So for now, I'll still remains the same, just in case of any wild whipsaw between 135.30 and 136.90. So maintaining that pivotal support at 134.70, which is very close to the 50-day moving average. Still maintaining our intraday bullish bias above 136.90, which is the intermediate resistance level. Exposes 138 figure, 138.30 next, which is close to the 1st of July minor swing high area. So However, if price action starts to break down below 134.70, then that would negate today's intraday bullish bias to see a residual extension of this ongoing minor corrective decline leg to expose the next near-term support level at 133.75, which is the minor swing low of 23rd of June, and also synchronizing it or confluencing with the medium-term ascending channel support that is still in place from 13th of January 2025 low. Right, so that's for the sterling dollar, maintaining our intraday bullish bias. Next up will be the Asia Pacific currency against the dollar, starting with the Aussie dollar. So Aussie dollar continues to push higher over here, so still holding above the 20-day moving average, and also the former 8-week resistance taken out on last week on 20 taken out on last Thursday, 26th of June, did a bit of whipsaw in today's early this week Monday session before shaping that bullish reversal, ex-post RBA meeting over here, which is an important key event. So with that, very likely that this minor corrective pullback from the high of 3rd of July all the way down to the low of Monday's low at the 64.80 short-term pivotal support, this level is likely this minor corrective pullback is likely to have ended, and right now we are in the midst of a potential minor impulsive bullish uplift move. All right, so with that, in today's Asia session, it managed to now have a breaking above that range top that is being seen on this Tuesday over here, this Tuesday, right after the RBA meeting, where it rallied, can't sell off and just trade sideways. So appearing that right now there's a bullish minor range configuration breakout from 8th of July to 9th of July, or 1 day of minor range over here. So this thing has already been taken out over here. Okay, so let me delete this. Right, so with that, I will be using a Titan short-term pivotal support level for today at 65.10, which is the 20-day moving average over here. So let me adjust it. 65.10. Okay, so this will be the next support level to watch, 64.80. Okay, so using 65.10 as my Titan short-term pivotal support level for today, still maintain our bullish bias on the Aussie dollar as a potential kickstart a new potential impulsive up move sequence. First resistance level to watch over here will be this minor congestion area here. Okay, this minor swing high of 3rd of July and 4th of July at 65.80. So it's a zone of 65.80 and 66 figure level, 0.6580. All right. So only a breakout above 66 figure level, which is the 11th of November 2024 swing high, potentially seek out the next intermediate resistance zone at 66.30, pardon me, 66.45. However, if it starts to have a breakdown again below 65.10, then potentially we may see a slide to revisit 64.80, which is the 50-day moving average as well. Only a breakdown below 64.80 will jeopardize the previous bullish breakout scenario, which is what's taken shape on last Thursday, and start to see another complex corrective movement back towards the lower limit of that sideways range configuration, exposing the next near-term support level in first step at 64.20, which confluence with the key 200-day moving average. So that's for the Aussie dollar, tightening our short-term pivotal support to 65.10 to maintain our intraday bullish bias. Next up will be the rather choppy, noisy dollar yen. So let's look at the dollar yen in the daily time frame. So the daily time frame in the dollar yen continues to evolve in this complex range configuration. So over here, we start to see it at 22nd of April low. It starts to be in this complex sideways range. So yesterday it got rejected at the former major ascending wedge support, previously running from the low of 16th of January 2023 low. So that's about 2 years back. Over here, previously it got rejected also on the 23rd of June over here, and now it got rejected yesterday. All right, so given said that perhaps right this complex range configuration, right, could be forming into a some kind of symmetrical range triangle at this point in time. Okay, forming a lower high All right, potentially. All right. So with that bearish shooting star, so this was a bearish shooting star that's being formed yesterday, a small bearish shooting star that's formed yesterday on the daily time frame chart on the dollar yen. That reduces the odds, right, for a initial residual push up that we have towards this towards this range higher at 14820, maximum what 149 level. All right, 14880 level, this level here. So initially we have a view that it may hit this range stop, non-range stop, hit the swing high area of 23rd of June at 148 figure, then maximum 14850 level over here. So that was something like also a, a kind of a ascending range triangle range configuration if such a scenario happen. But given the movement, the price action that has started to form a daily shooting star candlestick yesterday got rejected by this dotted green line here, which is the former major ascending wedge trend line support, now turns into a pullback support level previously from the low of 16th of January 2023. These two bearish element, as I described earlier, seems to reduce the odds of this kind of movement initially, which is a ascending triangle movement. So right now it seems to be taking on the form of a symmetrical triangle range movement. All right. So with that, I would actually now flip to a bearish buyer stance for today in today's Asia session. So using this support, this resistance zone at 14625 slash 14655 over here. So if I'll do the Fibo retracement, okay, it's also close to the 61.8% Fibo retracement at 14655 level. So using this 14625 slash 14655 short-term pivotal resistance zone on the dollar yen, so we will flip to a intraday bearish bias for a potential push down towards the middle part of this complex sideways range configuration that is in place since 21st of April. First support level to break will be at 14585, which managed to survive in today's Asia session. Below it potentially sees 14510 next, which is confluencing with the rising 20-day moving average as well. Only a bullish breakout and an hourly close above 14655 that would invalidate today's intraday bearish bias view and see it floating upwards towards the top of that range again at 148 figure level next. All right, so that's for the dollar yen. Okay, so that sum up the intraday technical outlook on the four major US dollar pair. So let us now focus our attention to the major stock indices, starting with the Hong Kong 33, representing the Hang Seng Index. So the Hong Kong 33 managed to also continue to be trapped sideways, but still holding above the pivotal support level that we highlighted yesterday at 23,690. RSI on the hourly basis continue to shape a higher high, which is a higher low, a higher low, which is positive. So still maintaining our intraday bullish bias at 23,690, but it's more like we in this kind of short-term range configuration. First two resistance level to watch will be at 24,050, which is yesterday's intraday high. Above 24,050 potentially takes us up to last Wednesday bullish rejection level at 24,270. Only a bearish breakdown and an hourly close below 23,690 will negate this bullish bias views for today to see it floating downwards towards 24,450 next. A breakdown below 24,450 will kind of invalidate this short-term intraday bullish movement. That means also breaking down below the minor ascending channel support very clearly from the low of 2nd of June, and potentially may start to kickstart a multi-day corrective decline move to expose the next near-term support level at 23,060 in the first step. So that's for the Hong Kong 33. Next up will be the Japan 225 or the Nikkei 225. So the Japan 225 continues to trade in this sideways range configuration. So we still maintain our bullish bias, but it's still more within a range configuration right now. Bottom part of the range is at 39,390 that got survived on this on Monday US session. So no change using 39,390. Maintain that bullish bias within this range, minor sideway range. Top of the range resistance will be at 40.40. So only a breakout above 40.40 potentially will see much more bullish momentum coming into play, exposing the next intermediate resistance at 40,355 and even 40,840/41,050 next in the short term. However, if price action starts to break down below 39,390, then this corrective decline sequence from the high of 30th of June may continue to extend further to the downside towards 39,145 and even 38,850, which is pretty much critical. So 39,145 confluence with the rising 20-day moving average. 38,850 coincide with the key pullback support of that former 6-week plus of ascending triangle range configuration that was previously in place since 13th of May and broken out to the upside on 25th of June. So this previously ascending triangle medium-term range resistance at 38,850 now turns into a critical pullback support at 38,850. So that's for the Japan 225. Next up will be the high-flying Germany 30, represent the German DAX. So the German DAX rally, as expected, hit our resistance level at 24,560/600, which is a fresh all-time high yesterday. Right, former all-time high was 24,495 based on the Germany 30 CFD index price movement that was printed on 5th of June 2025. So given that, okay, so this level has been met. Just remove this. So given that the hourly RSI has really hit the extreme overbought level and shape out a bearish divergence, so lower high, whilst price action squeezed to a higher high. So that indicated yesterday's move up is rather overstretched to the upside, and there could be a risk of a minor corrective pullback taking shape over here. So given that it's already hit the top of this minor ascending channel that we drew from, that is still in place since 20th of June, and with the FIBO extension level has really been made yesterday, coupled with the bearish divergence that's being seen at the rather extreme overbought level on the hourly RSI for the Germany 30. Right now, there could be potential risk of a minor corrective pullback taking shape after yesterday's steep rally. So with that, I'll be flipping to a intraday bearish bias for this potential minor corrective pullback to take shape on an intraday basis before a new bullish uplift resume thereafter, perhaps next week. All right, over here. So using 24,760 as my short-term pivotal resistance level, which is the one-time FIBO extension taken from the low of 20th of June over here. So 24,760 short-term pivotal resistance level. First support level to watch will be 24,400, which is the former all-time high swing high area, now turns into a pullback support. Breakdown below it exposes 24,320/24,260 next, which is the 38.2% FIBO retracement of this last steep move up from the low of 4th of July all the way up to yesterday's intraday high. So that is 38.2% FIBO retracement, which is the 24,320/260 intermediate support level to watch. All right, so these are the two key support levels to watch for today. 24,400, breakdown below it sees 24,320/260 in our potential minor corrective pullback view scenario. However, if price action continues to pierce up higher and break above the 24,760 short-term pivotal resistance, then we got to respect the bullish price action and invalidate the minor corrective pullback sequence bearish view for today, and continue to see the impulsive upmove sequence taking up higher new resistance level defined by FIBO extension cluster level, because there's no more all-time high area anymore. So 24,910. So previously there's no more price action like in the past. So these are fresh new price action. So fresh new price action, we got to define from a technical analysis based on FIBO extension level. So 24,910 will be next, will be the 3.618 FIBO extension taken from the low of 2nd of July, and as well as the FIBO extension clustering level from the low of 19th of June, and as well as 2nd of July at 25,040, pardon me, /25,115. So that's for the Germany 30. Next up will be the major US stock indices, starting with the US Wall Street 30, representing the Dow Jones Industrial Average. So once you're saying that yesterday we flipped to a bearish bias for the US Wall Street 30 because at its price action broke and retested the median line of this ascending minor channel drawn from the low of 20th of June, where it got rejected. Yesterday, Wednesday Asia session, it came down, can't break above our first support, bounced up but got rejected right exactly at our pivotal resistance level that we highlighted at 44,560 at the start of the US session, rallied towards the end of the US session but can't break and got rejected again. And during this rejection at the short-term pivotal resistance level that we highlighted yesterday, where we flipped to a short-term intraday bearish bias on the US Wall Street 30, anticipation of a potential minor corrective pullback, the hourly RSI has started to shape a lower high. Same high, lower high on the bearish on the hourly RSI, indicating a bearish divergence condition. So that also indicating the lack of upside momentum as well, despite yesterday's intraday recovery to seek out to retest the resistance level. So with that, we will still maintain our intraday bearish bias for today on the US Wall Street 30, potentially seeking out a minor corrective decline scenario to actually extend further downwards, all right, over here. So with that, 44,560 short-term pivotal resistance level, a breakdown below 44,170, where price action managed to survive on yesterday's Asia session, that would increase the odds of the minor corrective decline sequence extending further to the downside, exposing the next near-term support level at 43,800 / 43,600 next, which coming very close to the rising 20-day moving average. Maximum 43,290 / 43,160 is if 43,600 is being taken down on the downside. So this level over here, potentially this area here, that means 43,290 / 160 could be a potential sweet spot for the bulls to actually resume its bullish movement. Why? Because the price action is still trading within a short term and medium term bullish uptrend view. So what I'm trying to actually explain to you guys is that the bearish bias that I have on the US Wall Street 30 is not the start of a medium term downtrend. It's more like a minor corrective pullback sequence within a medium term uptrend. All right, over here. However, if price action today, instead of coming down and retest the 44,170 and breaking down below it, but it starts to do a bullish U-turn and cleared above 44,560, then we got to respect the bullish movement and state that the minor corrective decline view is invalidated, and we will see the continuation of the impulsive up move sequence to, in first step, retesting the current all-time high at 45,100, which was being printed in December last year. So that's for the US Wall Street 30. Next up will be the S&P 500. So very similar, the S&P 500 try to actually retest the current all-time high area at 62.90, but however can't break above. And what we could see is that during the intraday session, it came down, retest again, but during this print of this similar high, the hourly RSI shaped a lower high. And what you could see is that the retest at the former minor ascending channel support now turns into a pullback resistance as well. So with that, using 62.90 as my short-term pivotal resistance level, which is the current all-time high that was printed in 4th of July, still maintaining our intraday bearish bias, but first support level to watch for that pullback, corrective pullback to materialize is that it's at 62.20. A breakdown below 62.20 increased the probability of that minor corrective pullback scenario within its medium-term uptrend phase to expose the next two support level at 61.80 and 61.36, which confluence with the rising 20-day moving average. However, if price action managed to pierce up above 62.90 with hourly close above it, that would invalidate the minor corrective pullback scenario to see the continuation of the impulsive up move towards the next resistance level at 63.30 / 63.55 in first step. Next up will be the Nasdaq 100. So the Nasdaq 100 yesterday got rejected exactly at our pivotal resistance level, which is the current all-time high area at 4th of July at 22,920. So the hourly RSI also continues to print a bearish divergence. All right, over here. So with that, no change. Still using 22,920 as my short-term pivotal resistance level, still maintain that intraday bearish bias for this minor corrective pullback scenario to take shape. First support zone to watch will be at 22,600, 22,510. Only a breakdown below 22,510 may see a deeper corrective pullback to expose 22,360 / 22,235, which confluence with the rising 20-day moving average. Only a bullish breakout and the hourly close above 22,920, then I got to respect the bullish price action to invalidate today's intraday corrective pullback scenario for the bullish impulsive up move to resume, exposing the next near-term resistance level, which is a Fibo clustering level at 23,190 next in the first step. Right, so that sum up the intraday technical outlook on all the major stock indices. So very quickly now jump into the commodities market, starting with the gold XAU/USD first. So for gold XAU/USD, we have a bit of a whipsaw at the pivotal support at 32.93 yesterday. So yesterday it hit an intraday low of 32.82 before recovering. And the hourly RSI continues to print a bullish divergence. So with that bullish divergence, we do not want to be outright bearish right now. So it still continues to trap in this kind of sideways range that has been still in place since 3rd of July high over here at 33.60, where price action got rejected 1 time, 2 time, and 3 time in the whole of last week. So before turning down lower. So it seems to us that it could be some form of complex sideways range configuration as well, given that bullish divergence that's been formed yesterday. So no change, still maintaining that bullish bias within this range configuration, with the upper limit of the range at 33.45 followed by 33.60. 33.45 is the 20-day moving average. So with that, we have access 32.93/32.82 short-term pivotal support, still maintain our bullish bias within this kind of range configuration. Only a breakout above 33.60 will potentially see a much more higher chance of a bullish impulsive up move revival, exposing 34 figure level next in the first step. Above it, see a retest on the 16th of June minus swing high at 34.50. However, if price action continues, instead of pushing up towards the top of the range and thereafter continues to tumble downwards and break down below 32.82, then that would invalidate today's intraday bullish bias within a range scenario to see a bearish breakdown to revisit the current 20th of June minus swing low area at 32.50. Below it sees 32.05 next, which is the minus swing low of 16th of May and 20th of May. So that's for gold XAU/USD. Lastly, West Texas crude oil. So West Texas crude oil continues to trade in a minor sideways range now, holding below the short-term pivotal resistance that we highlighted, which now confluence with the 20-day and the 200-day moving average at 69.15, pardon me, 70.60. We also the former major descending resistance previously broke up and reintegrate back below it after the Iran-Israel ceasefire broker deal that's been brokered by US announced on 24th of June. So continues to use the 69.15, 70.60 short-term pivotal resistance level, maintain our intraday bullish bias within this kind of very sideways range configuration. So first support level to watch will be 67.80, where price action managed to survive on Tuesday. So only a breakdown below 67.80 potentially seek out a lower dip towards the bottom of this sideways range, minor sideways range configuration that is in place since the low of 24th of June at 66.10 followed by 65.20. We also correspond to the 50-day moving average. However, if price action shape a bullish breakout above 70.60, then today's intraday bearish bias view within this sideways range configuration has been invalidated to see the extension of this corrective rebound testing 73.60 intermediate resistance next. So that's for West Texas oil. I also sum up the intraday technical outlook on all the major cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to take note for today, which is Thursday, 10th of July. So for today, 10th of July, what we have over here during the European session, we have this finalized core inflation rate coming out from Germany. So that shouldn't be a big surprise because the preliminary figure has been released in 2 weeks ago over here. So I do not, potentially it may not be have a market moving impact at all. Something to take note of is at 2 p.m. Singapore time. And we have an ECB official speaking at 3 p.m. Singapore time, which is ECB Sepolon. Then thereafter will be a rather quiet session, and we have some tier 2 labor market data, which is the continuous jobless claim. So jobless claim has been rather on a weaker side in the last few weeks. So this is a weekly affair thing. 8:30 p.m. Singapore time, there will be a release of this continuous jobless claim, followed by 10 p.m. US Federal official speaking, Fed Musalam. Then thereafter will be a rather quiet session, followed by 1:15 a.m. Fed Waller speaking. Then we have 1:30 a.m. BOE officials, Fed Brendan, 2:30 a.m. Fed Daily speech, and that should be it for today's daily dose of market insight. So it's more of central bank's official speaking today, right, in terms of the key events to watch out for. So with that, that sum up today's daily dose of market insight. I'm Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.